The average credit card holder in the US this year in Q1 had a balance of $5,769. Last year in Q1, that average was $5,611. Now this data is going to be slightly skewed off the average depending on your age, race, location, and income. But if we look at the data since 2003, it's clear that America's got a problem. If you or someone you know is $100, $1,000, or even $10,000 in credit card debt, pay attention. In this video, I'm gonna show you how to eliminate that credit card debt paying 0% interest to the banks. But before we get too far into that, please hit the like button below, subscribe to the channel if you aren't already, and hit those noti bells. As you can imagine, it takes a lot of time for me to organize these ideas into a very cohesive and quick video that delivers the value right up front. I spend lots of time doing data research and ensuring that the quality of content in these videos are A1. So if you are in love with the sauce, show the channel some support. Back to the video. Balance transfers could be your solution to paying 0% interest in credit card debt. So balance transfers work by allowing you to shift your debt from one bank or credit card company to another.
So what's the benefit of wanting to move my debt from one company to other? Wouldn't that just be like robbing Peter to pay Paul? It ain't like it's just gonna go poof.
You see, the banks ultimately want you to owe them money because when you owe them money, they're gonna get interest payments. And they would rather you owe them money than their competitors. To be quite frank, they're betting on you to continue to spend reckless. So balance transfers are typically offered with a credit card promotion. If you haven't seen one, they usually have some sort of quote unquote deal where when you transfer money to them, they allow for 0% interest on that debt for a promotional period, let's say 18 months. The key here is the 0% interest only qualifies on the transferred balance, and any other spending on that credit card outside of that balance is considered normal credit card use and will be treated as any other normal transaction to the card. It should also be noted that there will still be a required minimum payment on that transferred balance, just like it would be on the other credit card. The only difference is now that transfer balance doesn't have interest on it. It would all be a purely principal payment. Therefore, the minimum payment during the promotional period will ultimately be lower because it doesn't account for that interest, which could be an added benefit for you if your minimum payment before was too large to handle. I need to drive home how powerful this is. Credit card rates are usually between 17 to 25%. If we take these credit card rates with the average amount of debt that Americans had in Q1 of this year, Americans are paying on average anywhere between $980 and $1,440 a year in interest. This means that 2 to 4% of the average American's yearly income is going straight to credit card debt interest. And that's not even accounting for the interest and the fees that are coming from all the other things in people's lives these days. So if you do a balance transfer, you should treat the interest savings as a 2 to 4% raise and more money for you to use towards your actual principal on your payments each month.
So you telling me the banks are gonna basically allow me to transfer money into their bank, and if I do what you're saying, I basically am able to pay off my debt with no interest given to the bank. How does the bank win? They always gonna get something, right?
That is exactly right, actually. With these balance transfers, banks are usually gonna have some sort of a fee attached. And that fee is gonna range somewhere between 3 to 5% or $10, whichever is larger. To find out if a balance transfer even makes sense for you, here's your calculation. Number one, we need to start with the amount owed on our credit card. Let's say in this case, we owe the average $5,769. Number two, we need to establish what our timeline is gonna be for paying this debt off, okay? Now you wanna use something realistic here because it's gonna matter for the calculation. In this example, we're gonna say we're gonna pay it off in about 6 months. Number three, you need to look at your credit card statement and find out what your credit card interest is. Let's say for this example, we're at 17%. We've got pretty good credit. Number four, we need to take that credit card interest and divide it by 12 because it is an annual interest rate. That is gonna give us our monthly interest that we would actually have on that balance. For this example, our monthly interest would be 1.42%. Now we take that number and we multiply it by 6, or the amount of time you're planning to take to pay your debt off. That's gonna result in this example for a monthly interest payment of $81.72. Jesus. So in 6 months, we would be paying $490.32 in interest. It'll be slightly lower than that because you're aggressively paying towards the principal. This is scratch math and it's to give you an idea. And lastly, if we were to do a balance transfer instead on the same amount of debt owed with a 4% fee on the same $5,769, that would be $230.76. That means that I saved $259.61 in 6 months just by moving my debt from one bank to another. There are stories out there of people saving thousands of dollars doing these balance transfers. You can do balance transfers multiple times. If you have a very large credit card debt balance and it's going to take you longer than the promotional period to pay off, very near your promotional period's end, you can roll it into another balance transfer with another card and continue to do this until you're able to aggressively pay the debt off. If you were to do this every time your promotional period was close to expiring, you'd basically be dodging interest from the banks. But the key here is that you need to do the scratch math to determine if it even makes sense to do that after the second and third time. So now that you've seen how powerful a balance transfer can be, you only need one thing to make this happen. 2 credit cards. You see, you need the credit card with the outstanding debt on it and then a credit card to transfer it to. If you don't have the second credit card, you need to consider opening up another credit card so that you're able to reap this benefit. Depending on where your credit is, it can be slightly difficult to get that second credit card if you don't have one. The Discover It card with balance transfers, for example, has a minimum credit score requirement of 670. So you need to do a little bit of research here to find out what a great card for you is. Now, normally I wouldn't recommend opening another credit card if you are already having issues paying on your first credit card. However, if it is understood that you are using this card only to do a balance transfer and you aren't planning to spend any more money on that card, then it can be a good option. Really take the time to do some research and assessment on your current situation to determine if this is a good strategy for you, because a behavior change is critical to make this work. You don't want to go running up the old card because you don't have any interest payments anymore. Balance transfers can be a powerful strategy if you find yourself with a very large credit card balance and you're ready to change your financial habits. The only risk here is that you continue to run up your cards after doing the balance transfer. Balance transfers can save you thousands in interest. Let me know in the comments below some other ways that you know of to get your credit cards paid off. Thanks for watching.